Thank you, Courtney, and thank you everyone for joining us today for our discussion about the economic road ahead. Before we jump into my presentation today, I'd like to give you a brief overview of what we'll be discussing. I'm going to start off talking about my and ITR's general macroeconomic outlook for the U.S., what's happening in the economy, what happened in 2016 and the transition to 2017, followed by our general outlook for the next 3 years. After that, I'd like to address some of the potential changes that we're seeing coming out of Washington. And while everything is still very much in flux, talk about what that might mean for different aspects of the economy. After that, I'd like to take a look at the red metals industry and look at some of the current leading indicator evidence and projections moving forward. Finally, I'd like to zoom out a little bit and get an international look and see different trends in the major economic regions throughout the world. After that, I'd like to kick it back to Courtney, and I'll field any questions that you might have. And now, first off, I know that we have some listeners here today who aren't familiar with our terminology and methodology that we use here at ITR, because a lot of it is fairly proprietary and not quite orthodox. So I'd like to briefly go over this slide here. And if you're coming back to review this presentation, either by yourself or with your colleagues at a later time, this is a great slide to get a general overview and the kind of nitty-gritty definitions of exactly what I'm talking about to make sure that we're all on the same page. Moving through these slides, you'll hear me mention two main metrics that I use while discussing different segments of the economy. These two main metrics are our data trends, which consist of moving totals and moving averages. The reason that we use moving totals or moving averages are to smooth out the inherent volatility included in any data series on a month-to-month basis. Because here at ITR Economics, we are a long-term business cycle theory group, and we're less concerned with day-to-day movements within markets and more concerned with overarching long-term trends. You'll see that we use both moving totals and moving averages, and the difference between these is simple. We use moving totals when various aspects of the economy are able to be logically summed up. You can imagine using moving totals for metrics such as units shipped or total dollar valued sales. Moving averages are more useful when summing up different metrics of the economy doesn't necessarily make sense. Imagine production indices or rates of change. We have two primary moving totals or moving averages that we use. And we also describe these as the 3 MMT or 12 MMT. The 3 MMT is simply the most recent 3 months of data. The 12 MMT, or annual total, is simply the last year's most recent 12 months of data. For both the 3 MMT and the 12 MMT, we have analogous rates of change that you'll hear me using very often. Those are the 12/12 and the 3/12, or the annual and quarterly growth rate, respectively. The 3/12, or quarterly growth rate, is simply the most recent 3 MMT compared to the 3 MMT 1 year before. So it's the most recent quarter of data compared to the same quarter last year. This is why you'll also hear me refer to it today as the quarterly growth rate. Much in the same vein, the annual growth rate, or 12/12, is simply the most recent year's worth of data compared to the year before that. The reason that we use rates of change is to get a good metric of the cyclical momentum of any company or business or aspect of the economy. And this lets us look at progressive rates of change and progressive improvement or weakness within any aspect of the economy, as opposed to getting caught up in the nominal dollar-valued or unit-valued segment. Whenever you see any forecasts that we have throughout this report, you'll see that we're referring to the 12/12. The reason we do this is because the 12/12 is what we base our business cycle theory on. Our business cycle, as defined by us here at ITR, has 4 distinct phases: phase A, B, C, and D. You can see at the bottom half of my screen that we have a graphic representation of this business cycle in that 4-colored sine curve, as well as their definitions next to it. In the bottom left quadrant of that sine curve, we have a graphical representation of phase A, recovery. Phase A, we call recovery, is because it's when you are contracting on a year-over-year basis. Your 12/12 is below 0. However, it is moving upward toward that 0 line. So while things are declining on a year-over-year basis, they are becoming progressively slower and slower in their pace of decline. Once that 12-12 upward passes the zero line and transitions to year-over-year growth, we define that as phase B, accelerating growth. Phase B is defined as when the 12-12 is above the zero line, so there is year-over-year contraction, and the pace of rise is getting faster and faster, so that 12-12 is rising. Once that 12-12 peaks, we transition over to the yellow segment of the sine curve, or phase C, slower growth. This is still a positive aspect of the business cycle because we are seeing year-over-year growth and things are getting progressively better compared to the year before on a month-over-month basis. However, we consider this the cautionary phase of the business cycle because that pace of growth is slowing and the 12-12 is moving down towards the zero line. This is when you run the risk of falling into phase D, recession. We define recession as any time that the 12-12 is below zero, so you're contracting on a year-over-year basis, and it's moving away from that zero line. So the pace of decline is deepening. Obviously, this is the worst phase of the business cycle to be in, but there is good news. At any given time, although we define in our theory 4 distinct phases of the business cycle in a continuum, we don't always transition between all 4 phases of those business cycles within any overarching cyclical period. Instead, we can have what we consider a soft landing. This is when you transition from phase C, slower growth, the cautionary phase of the business cycle, directly back to phase B, accelerating growth. So your 12-12 is declining, but it reaches a cyclical trough and transitions back to rise before reaching that zero line. This is the best phase of the business cycle, and if it was up to me, it's the phase that you and your colleagues would be in all year round. However, we know that's not possible. This is most generally seen during economic boom times. Conversely, we have the worst case scenario, which is a hard landing. This is where any company or segment of the economy is currently in phase A, recovery, so that 12-12 is moving up to the zero line, and we see that figurative light at the end of the tunnel. However, it reaches a cyclical peak before transitioning the year-over-year rise and falls directly back into phase D, recession. This is generally seen during periods of significant structural shocks within the economy or just general macroeconomic recession. Again, if at any time you are confused by any of the terminology I'm using or you'd like to come back and get a refresher, I encourage you to come back and look at this slide. And now I'd like to, as I mentioned before earlier, comment on our overall macroeconomic outlook. And in doing that, first we'll look at U.S. industrial production. U.S. industrial production is our benchmark for the industrial economy within the U.S. and also one of our major benchmarks for the U.S. economy as a whole. It comprises 3 main components: utilities, electrical and gas utilities, manufacturing, and mining. Of those 3 segments, manufacturing is the only one which is in the front side of the business cycle and is expanding on a year-over-year basis. It's currently in phase C, slower growth, and is up about 0.4% year-over-year, so virtually even with the 2015 level. That's not breakneck growth at any description. However, it is more positive than both mining and utilities, which have been weak enough to pull U.S. industrial production into phase D recession throughout the majority of 2016. We saw these recessionary pressures begin to mount in late 2015 as we're in a late phase C. And in the beginning of the year, we fell into that phase D recessionary trend. Mining is where the majority of the weakness we're seeing in the U.S. industrial economy is focused right now. And most of that is because of the meteoric drop in oil prices that I'm sure you're all aware of and has materialized from late 15 throughout the majority of 2016. That weakness in oil prices was corroborated by a resulting weakness in a lot of metal commodity prices as well. And generally, the weakness that we're seeing here in the mild nature of this recession isn't due to overarching cyclical pressures, but instead negative pricing pressures. However, I don't want to dwell on the negative too long because in the 4th quarter of 2016, we did see some positive movement in the U.S. industrial production 12-12. It did tick up to about negative 1.2% year-over-year, signaling a tentative transition to phase A, recovery. While we generally wait about 2 or 3 months of consistent rise in the 12-12 before calling a definitive transition to any phase of the business cycle, This early period of rise is corroborated by the quarterly growth rate, which is up or down about 0.7% and is currently outperforming the annual growth rate. And also the U.S. leading indicator, the ITR proprietary leading indicator, and also the U.S. Purchasing Managers Index for manufacturing. That's some strong statistical and leading indicator evidence that supports our outlook of further rise in the U.S. industrial production 12-12, and that recovery persisting into early 2017 before general acceleration throughout 2017. We expect 2018 to be a growth year as well. However, it will be characterized by that Phase C transition. We expect U.S. industrial production to finish 2017 up about 2.7% year over year, followed by slower but still positive growth of 1.1% in 2018. Moving into early 2019, we expect the U.S. industrial economy to fall into Phase D, recession. Now, I know that's a nerve-wracking word at this point, and anytime we hear that word recession, we immediately think back to the recession about 8 or 9 years ago to 2008. However, I want to caveat you that this isn't going to be a capital R recession, and there is going to be no widespread or severe shocks as severe as we saw during 2008. Instead, this recession is going to be driven primarily by a cool down in the U.S. consumer economy, slower growth in the housing market, and rising interest rates. We expect to be down about 3% year over year. So imagine something more akin to the recession of the late 90s and early 2000s as opposed to 2008. It's nothing to necessarily panic about, but you definitely want to keep it on your radar. Here at ITR, our long-term business cycle allows us to see these recessionary periods and growth periods coming so that we can expand upon growth periods and mitigate periods of decline. And that's why I want to bring that to your attention. This recessionary period will color the majority of 2019 before, in the end of the year, we transition to a recovery phase and growth begins anew in 2020. The industrial segment of the economy wasn't the only portion of the economy that was hit hard in 2016. In fact, U.S. non-defense capital goods new orders, and I know this is a mouthful of a term for a segment of the economy, but what U.S. non-defense capital goods new orders is our metric of business-to-business activity and business investment. It includes such things as heavy machinery, industrial and agricultural machinery, office equipment, and computers. Basically, anything that corporations need to function on a day-to-day basis is generally included within capital goods new orders. Capital goods new orders is down 4.0% on a year-over-year basis and is currently in Phase A, recovery of the business cycle. However, if you look at this dark blue line here, which does indicate our 12-12, you can see that this recovery has been relatively slow, and we've seen weakness since mid-2015. What's been driving U.S. non-defense capital goods new orders is less a matter of demand from the U.S. public, but instead, once again, those negative pricing pressures. Especially the severe drop in iron and steel prices that we saw in the first half of 2016, coupled with late 2015, have really impacted U.S. corporate profits and have squeezed the profit margins of a lot of different companies and corporations. Because of that, a lot of purchasing managers have been very hesitant to make large capital goods replacements, and they've been essentially doing more with less and trying to increase the productivity of their standing capital while also including expanding upon the lifespan of their capital through things such as services and preventative maintenance. However, we are in that general Phase A recovery trend, and we do expect the transition to Phase B accelerating growth by mid-2017. This is a very positive sign for the economy, and coupled with rise in the U.S. Purchasing Managers Index that I mentioned earlier. And for those of you that don't know, the Purchasing Managers Index is based on a questionnaire that is sent out to purchasing managers within various aspects of the economy and is based on real current market conditions. So it is not an optimism index or anything like that. Instead, it is a questionnaire regarding actual economic activity within a variety of manufacturing fields. That is rising on a rate of change basis, which supports our expectations of cyclical momentum moving into 2017 and 2018. And in general, we expect a fairly significant rebound effect from the capital purchasing that has been put off in late 2015 through 2016, and we expect to see that kind of bolster purchasing in 2017. So anyone involved in the production or distribution of capital goods will undoubtedly have a much better year in 2017 and 2018 as well, compared to the most recent year in 2016. Now that we've talked about a bit about the U.S. industrial economy, I want to step back a little bit and get a more holistic picture. Here we have U.S. gross domestic product, or GDP, which is our most inclusive view of the U.S. economy, and it attempts to capture the sum total of economic activity within any given country. On the left, you can see our data trends, our 12-month moving total for U.S. GDP. You can see that it's generally rising and has been doing so since about 2009, in the advent of the recovery from the 2008 financial crisis resulting recession. You can see on the right the year-over-year growth rate. It's currently in phase C, slower growth, up about 1.6% year-over-year, which is a marginally lackluster growth rate. It is nothing to panic about. However, we do like to see growth rates in the low 2% range instead for such a mature economic powerhouse like the U.S. However, we are on the cusp of a transition to phase B, accelerating growth, and one of those soft landings that I mentioned earlier. Much like U.S. industrial production, we expect general acceleration into 2018, followed by slower growth moving into 2019. And then, as with the U.S. industrial economy, a general recession, albeit mild, within U.S. GDP. So this is presenting kind of a dichotomous view of the U.S. economy. We have relatively severe industrial weakness and contractionary periods within capital goods production, but general economic growth. So that leads us to ask the question, where is this growth coming from? Why isn't U.S. GDP in a recessionary period as well? And to answer that question, I'm going to break down U.S. GDP by consumption. This is breaking down U.S. GDP as of 2014. It hasn't changed much since then, but we'll see as the official data comes out. This is breaking down U.S. GDP by three major consumption groups. You can see that we have business investment in 16%. For a proxy of that, you can look back to capital goods new orders, as I mentioned earlier, followed by government spending at about 18%, followed finally by U.S. personal consumption at 66%. So 2/3 of U.S. GDP is made up by personal consumption. It's the old adage that the U.S. consumer is king, and it's very true. Wherever the U.S. consumer tends to go, so tends to go the U.S. economy in general. Taking a look just by the numbers, here we have U.S. total retail sales deflated. We deflate this index in order to account for actual economic activity at retail outlets, as opposed to fluctuations that would be caused by inflation in the varying cost of goods on a year-to-year basis. You can see that U.S. total retail sales is currently up 2.0% on a year-over-year basis. That isn't the strongest growth that we've seen in the last 10 years or so, but it is relatively impressive and indicative of a healthy U.S. consumer. You can see that we're in a general phase C, slower growth trend, which will persist into early 2017 before we see that familiar trend characteristic at this point of acceleration moving through 2017 and into 2018. Based purely on the numbers and how much the U.S. consumer is spending, it does seem that the U.S. consumer is healthy enough to keep the economy afloat. And this explains why. Here we have U.S. private sector employment. Again, you can see that overall U.S. private sector employment in millions of jobs has been rising since the wake of the 2008 recession. Private sector employment growth is currently up 1.9%, and job openings are up 6.5% year over year. We're also seeing a decline in the involuntary part-time employment index. And what involuntary part-time employment is part-time employment for economic reasons, or as it says, non-voluntary. A lot of times what you see here is an unemployment rate that is low, but is sending false signals, because a lot of those jobs have been transitions from more lucrative full-time wage or salaried positions toward these part-time positions. Imagine a retail position or something at a fast food restaurant. This often happens in the wake of severe economic shocks, and we saw it happen in 2008 and 2009, where people are forced to take on 1 or 2 or 3 part-time jobs in order to just try and compensate for the lack of their previous job. Generally, rise in the involuntary part-time employment rate is indicative of a weak consumer and poor consumer health overall, but you can see that it's down negative 6.7%. This indicates that not only are we adding jobs, not only are job openings accelerating within the U.S., but in general, the jobs that U.S. consumers are getting are more lucrative and more beneficial and more viable in the long term. That speaks to pretty significant long-term health for the U.S. consumer. However, as I mentioned the economist's view before, as with most things in economics, there's another side to the story here. You can see that the U.S. quit rate is rising within the private employment sector. The quit rate is simply the average rate at which Americans are quitting their jobs, how often they either quit jobs to become unemployed or quit jobs to switch to a different position. The reason this is dangerous is because basically U.S. consumers are confident enough in the tightening labor market that they expect that if they're not getting the salary or the incentives or the bonuses or perhaps vacation time they want at one job, they feel confident enough in general to quit their job and look for something better or look for something more enjoyable or more lucrative. Because of this, it's vital that you focus on retention rates moving to 2017. We only expect the labor market to tighten. All of the leading indicator evidence suggests further tightening within the labor market, as well as the numbers themselves. Especially when it comes to the younger demographic, the so-called millennial generation, managers have had a hard time getting them to remain in one job for a significant period of time using traditional metrics, such as increased pay or quarterly bonuses or anything like that. Instead, what we're seeing is that millennials like what I consider quality of life improvements. They might like the option to work from home every once in a while and telecommute, or perhaps a less flexible entry time or exit time from the workplace, or maybe even something as easy as being able to ditch the tie and put on some jeans. These are real easy ways that if you can get the thumb on your younger workers and kind of see where their heads are at, you can increase employee retention without driving up labor costs. That brings me to my final terminal management objective concerning the labor force, and that's that budget for rising labor costs throughout 2017 and 2018. While a tightening labor market is good for employees as wages rise and good for the economy as consumers consume more, it means that you're going to be paying more to keep your employees and find your employees. And while it is going to be an economic growth year over the next 2.5 years, that economic growth and increased productivity is useless if it doesn't keep pace or exceed your labor costs. So that's one thing to keep in mind moving over the next 2 years. Here we have U.S. housing starts, which is a great economic indicator for a lot of reasons. For one, it's further evidence that the U.S. consumer is relatively healthy. You can see that U.S. housing starts are expanding on a year-over-year basis. They are in a phase C slower growth trend. However, we do expect this indicator to avoid recession over the next 2 years. Moving into the recessionary period that we expect in early 19 for the U.S. macroeconomy, we expect general growth within the housing market. So I don't want you to be dismayed by the decline in these rates of change that you see on top, but instead look down bottom at the 12 MMT, which has been persistently rising for the last 6 or 7 years and will continue to do so for the next 2 years. One of the primary motivators for this is decline in the average mortgage rates, coupled with rising wages and disposable personal income. That just facilitates ease and affordability of home buying. Also, there's been a lot of talk of, again, the younger millennial generation putting off major life goals such as marriages and buying homes. However, as they start to hit the workforce en masse and start to age compared to where they were a few years ago, they really have kick-started the U.S. Housing market, and we expect that to persist over the next 2 or 3 years as well. Also, U.S. housing starts is a powerful indicator of the macroeconomy in general, and as it turns the corner, further provides some evidence of acceleration within the macroeconomy as well. Now, this is a chart I like to point out, and it's especially salient this time of year as we're moving toward a presidential transition and politics has been in the news and on all of our lips and within our newspapers over the past few months. What we have here is U.S. real gross domestic product, the real signifying that, once again, this is gross domestic product adjusted for inflation, since 1950. You can see that the red portions of the graph are when Republicans controlled the White House, and the blue is when Democrats controlled the White House. And what you'll find is that there is no significant statistical correlation between rise or decline in the real gross domestic product quarterly growth rate and whether or not red or blue controls the White House. If you're looking at the data and just counting up, you can say, but wait, there have been more economic recessions during times of Republican control. However, the Republicans have also had a slightly longer tenure over the last about 60 years or so, and also a lot of those economic recessions occur during transition times, right after a Democrat is in office. Generally, recessions are due to overarching cyclical trends within the economy that aren't very easily quickly moved. And because of that, whatever happens within one administration can have overarching effects over the next few years. The reason I want to bring this up to you is because there's always speculation during an election year of what does a Republican or what does a Democrat mean for the economy. You'll hear people claiming that one house is inflationary while another is recessionary. And I hope you can look at this and just see that, in general, the data doesn't support that either way. But while we can't say whether any period of time is going to be recessionary or inflationary based just on what party controls the White House, what we can do is get a little more granular and look at some of the talking points that have been coming out of the new Trump administration. While President-elect Trump hasn't verified or hammered down the details on a lot of his plans, he has made it very clear what a lot of his overarching views are. For example, he's been talking about large infrastructure investment throughout these large billion-dollar projects throughout the economy, throughout the U.S., and that would generally be a very beneficial move for the U.S. economy. Infrastructure, especially highways and bridges in many portions of the U.S., especially the more rural ones that receive relatively less funding from the feds, has been in a relatively sorry state for years. One of the most important keys to long-term economic growth is facilitating the transfer of goods and services, and one way that we can do that is by investing in our infrastructure. Not only will it secure economic growth in the long term, but in the short term, it will also act as a fiscal stimulus and inject money from the government directly into the consumer's pocket and help, again, that 66% of the U.S. economy keep firing on all cylinders. We also see him talking about increased tariffs and general trade protectionism. This goes along with talk about perhaps repealing or renegotiating NAFTA, the North Atlantic Free Trade Agreement. And in general, this is one of the riskier moves that President-elect Trump has proposed. Generally, when we see rising tariffs and protectionism in general, there are winners and losers. Winners will be domestic manufacturers, domestic mining companies, and other base manufacturers who generally have to compete with lower prices from abroad. The losers will most likely be those who polish intermediate goods into final goods and kind of add the finishing touches as they see rising costs. And the U.S. consumer in general, who can expect generally higher prices with no real significant economic growth outside of those industries. Directly after the results of the U.S. election, we've seen mixed signals from the stock and bond markets. The stock markets are up, and we're seeing general growth there, which is fairly strong positive evidence for short-term growth. Generally, the stock market is a little short-sighted compared to the bond market, and it indicates that corporations and investors think they can make a quick buck over the next 3, 4, 5, 6 months, maybe even a year. In general, that supports our expectation for accelerating growth throughout 2017, as it's generally corroborated with a short-term rise in economic activity. However, we've also been seeing risk signaling and essentially rising interest rates from the bond markets. And that shows that while there is some potential for short-term growth, in the long term, expectations are a little less hesitant and people are demanding more for their money. There's been a lot of talk about decreased corporate tax rates, and again, I can say this all day long, there will be winners and there will be losers. The positive sides of the economy will be that it hopefully will bring back some U.S. corporate finances back domestically from abroad. The U.S. does have a relatively high marginal corporate tax rate compared to most of the developed world, so that would most likely lead to some positive pressure within the economy. However, the real risk comes not from decreasing corporate tax rates, but from decreasing corporate tax rates with a lot of these other economic policies, for example, infrastructure spending and increased tariffs. What we risk here is increased spending during a time of tax cuts, and that it would be similar to what we saw under President Bush, and even moving into Obama's early years, where we see a ballooning public debt and rising national debt without any real way of spending it down. Again, this would most likely be inflationary and supports our expectation of general growth over the next 2 years. But once again, this poses a long-term threat. This is a juggle we see a lot on the national level when the federal level gets involved with not just politics but economics, where they're trying to balance long-term growth in sustainable, viable economic health compared to short-term immediate alleviation from economic woes. Again, it stands to be seen where a lot of this plays out, and we haven't seen this translate into the data yet outside of some financial markets, and you'll have to stay tuned to see what actually happens. After that, one of the other large topics is more stringent border policies, stricter immigration, and an end to nearshoring or outsourcing. Again, this will likely help industries that are very labor intensive and less capital intensive. For example, workers in the automobile industry would most likely be proponents of this. And it will help areas such as Detroit, where they have a lot of that base labor intensive manufacturing concentrated in one area. However, once you start bringing back labor intensive manufacturing, again, you're seeing that general rise in price levels. And also with slower immigration, we could see an exacerbation of the current tightening labor market over the next few years, and corporations may begin to struggle with even faster rise in their labor costs. And finally, a lot of people's concerns and questions rely on our expectations for interest rates in that side of the pseudo-governmental decision-making process. Here we have the Federal Open Market Committee, the FOMC, member interest rate projections. You can see these are, as of September 2016, these are their third quarter projections. And by 2017, they do expect rate hikes flowing up through the mid 1% to 2%, followed by it evening out around 3%, upwards of even maybe 3.5, 3.75 percentage points in 2019, followed by the years after that. Again, this supports our expectations of generally higher borrowing costs, a tightening labor market, and economic expansion in general, coupled with inflationary pressures. And it does pose a risk for 2019 and beyond, as persistently high interest rates do tend to subdue economic activity. However, in the short time, it definitely seems like there is ample leeway for the Fed to raise their interest rates. In general, we expect to see positivity over the next 2 years, really regardless of what the Fed decides on a month-to-month basis. And now you can see our fourth quarter projections, which, while they were a little less lackluster for moving through 2016, as we move to close the year, they're generally in line with the FOMC's earlier expectations. Normally, interest rate movements can have kind of a shadow of a doubt cast upon them when the FOMC members rapidly change their expectations from quarter to quarter, that signals a lot of economic uncertainty amongst otherwise well-educated individuals, and we're just not seeing that right now. Unemployment is falling, wages are up, growth is beginning to take hold in some of the manufacturing sectors that have been hurting, and because of that, it's very strong evidence and a good bet that we will see that kind of immediate rise in interest rates. Now I'd like to dive down into the red metals industry a little bit, and here we have the U.S. primary smelting and refining of copper production. So other than mining, this is the most basic level of copper production. You can see that it's currently up 12.3 percentage points year over year. However, it is in a phase C slower growth trend. This industry does tend to fall into recession, and we do expect mild recessionary pressures moving into 2017. This seems contrary to our expectations for the overall U.S. business cycle, which will be characterized by growth over the next 2 years. However, instead of getting caught up on the growth rate on the right side of my screen, I want to focus your attention on the moving totals on the left. Here we have the annual average, the 12-month moving average. You can see that, as I mentioned before, this industry does tend to fall into recession, and you do see these peaks followed by these humps, generally over and over. But if you look at a trend line, either peak to peak to peak or trough to trough to trough, since the wake of the 2008 recession, every peak and every trough has been followed by a successively higher peak. And this is what we see in generally volatile commodity-based industries, even during times of economic recovery or expansion. So while we do expect some downward pressure over the next 2 to 3 quarters, in general we have opportunities for economic growth moving into 2019 in the U.S. economy as a whole and also within the copper industry. Here we have U.S. private non-residential construction. It's a leading indicator for the copper industry that's taking a very similar trend characteristic. It's stayed out of recession over the past 2 business cycles and likely will do so as economic activity picks up moving into 2017 and 2018, but it is still in that phase C slower growth trend. We expect that transition to occur by mid-2017, which will drive further accelerating growth within the copper markets. And again, you can see here that we have surpassed our pre-2008 peak within the U.S. private non-residential construction sector. And the reason I like to point that out is because this industry was less subject to the severity of the kind of bubble spending in the run-up to 2008. And because of that, we do expect to see general economic growth past that 2008 level, where if you're looking only at the residential side of things, a lot of times you would be coloring your expectations to remain below what we saw moving up to 2008. That's simply not true with the non-residential construction portion of the U.S. economy, and we do expect general upward pressure regardless of the oscillations in the rate of change. We expect general year-over-year growth moving into 2019 in this segment. Here we have China power generation. China power generation is often an economic indicator that can be met with raised eyebrows. And if you don't follow it personally, it can seem a little out of place when talking about the U.S. However, U.S.-China power generation is used as a proxy for general economic growth within China, and actual general economic activity. Due to the Chinese government's involvement in setting preferred growth rates for different economic indicators and artificially stimulating the economy in order to meet those growth rates, a lot of times there can be some doubt cast as to the exact validity of the growth rate. Maybe China says 6%, but other people think between 5.5% and 6.5%, for example. And so we look at China power generation, which tends to be less volatile and a more accurate indicator of actual economic growth. You can see that after just brushing the zero line, it transitioned to phase B, accelerating growth. We've seen early upward movement in the China overall industrial production 12-12 in that early transition back to phase B, accelerating growth. And coupled with increased freight being moved, growth in the Chinese residential and non-residential construction sectors, as well as increased demand for power throughout the Chinese economy, that corroborates our what we're seeing in the data of a transition to phase B, accelerating growth for the Chinese economy as a whole. The reason I include this is because China is one of the largest consumers of copper in the world, and while there is some weakness at home, and we see that kind of dip in the primary smelting and refining of copper production index, it's a great time to either focus on or attempt to transition and enter into the export markets, especially geared toward China. And again, there's always a second side of the story. With increased demand and general growth in the copper industry, generally leads to rising prices. Here we have the U.S. Copper and Brass Producer Price Index. I don't want you to get confused with copper commodity prices, which are generally rising as well, but instead this is industry-wide throughout the U.S. copper and brass industry, what baseline initial producers on the average can expect to get for their products. You can see that we've just recently transitioned to Phase A recovery. The price index is currently down 10.5% year over year, which highlights some of the negative pricing pressures that I mentioned earlier affecting a lot of people involved in mining and manufacturing. But you can see that there is significant sustainable rise in the producer price index, which will likely persist through the next 4 quarters. The current negative 10.5% growth rate is our most recent data available by the Bureau of Economic Analysis for November. We expect it to tick up mildly through 2016, being just about down 10%, followed by acceleration and finally leveling off in 2017 at about 5% year-over-year growth. This will help relieve some of those negative pricing pressures against your books that you've likely been feeling over the past year. However, this is also a time when you want to be very conscious of your pricing decisions. During times of economic growth, the economic demand will be there for you to realize increased productivity and increased sales. However, you don't want to be undercut by your competitors. So during this growth time, keep a thumb on the pulse of the market and try and maintain a competitive pricing structure. You want to prioritize market share over margins over the next 2 years in order to be in a good position to weather the 2019 recession. As I mentioned before, copper prices are generally rising. On this graph, you'll see the 312 rates of change, or quarterly rates of change, for 6 different major metal commodity prices. Copper prices are generally growing. They're up 12.9% compared to the 4th quarter of 2015. However, they are growing generally slower than most other metals. This is common for us to see in copper. When copper prices make significant rises or declines, it's generally indicative of an economy-wide trend, as opposed to anything relating to one specific metal. So what I want you to get out of this chart that I have for you is just proof positive of the inflationary pressures that we're expecting, and I've been mentioning, for 2017. This is really when you have to take time to look at your books, and as prices rise, phase out your marginal opportunities, lose the losers, and focus on the winners. Now you can see here that we have color-coded U.S. industrial production maps of various regions. Here we have North America. You can see that the U.S. was the middle of the road between the 3 North American countries, with Canada underperforming and Mexico overperforming. While Canada is depressed on a rate of change basis more severely than the U.S. is, it is in a Phase A recovery trend, and we expect the same characteristics that will drive growth in the U.S. in 2017 to drive growth in Canada in 2017. Mexico is virtually even with the prior year. They've been outperforming as they've been attracting a lot of labor and manufacturing jobs from Canada and the U.S. Moving into 2017, or moving further into 2017 now, it's a good time to look to Mexico and try and fill demand from Mexico while you're waiting for demand on the industrial side of the U.S. to pick up by mid-2017. Here we have Latin America Industrial Production Index. Again, you can see that it's in that familiar Phase A recovery trend, a little more pronounced than it is in North America. It's currently down 4.8%, and we expect it to finish just barely up over 2016, up about 0.5% in 2017, followed by acceleration into late 2018, finishing the year up 3.8%. With their close economic ties to the U.S. and North America in general, we do expect general inflationary pressures to build in early to mid-2019 in Latin America. You see a lot of red here. In general, everyone's down about 2 to 3%, with the exceptions being Colombia and Brazil. Colombia, which has a relatively diverse economy and isn't as dependent on fossil fuels and commodity price goods in general compared to a lot of their neighbors, are doing very well. They're currently up 4.0% year over year. While Brazil, with their regime changes, dependence on oil, and kind of political skepticism and uncertainty, is down 8.4% year over year. We expect Brazil, the largest economy in this region, to break into year-over-year growth by late 2017. However, the growth will be mild, and Brazil will be an area of caution if you deal with them moving into 2018. Next, we'll take a look at Europe. Europe industrial production. This includes both EU and non-EU member states, Eastern and Western. It's currently up 1.3% year over year and is in a phase C slower growth trend. Europe in general, and the major players in Europe, have avoided recession in this business cycle due to their diminished dependence on oil compared to most other aspects of the developed world. We expect them to avoid recession despite the slower growth trend moving into 2017, and will remain out of recession moving into 2018. Europe will be a strong area of opportunity, especially moving into late 2018. And if you can transfer over to the export side of the economy or focus more on that side of the economy in late 2018, the demand will be there and will help you to diminish the effects of the coming recession back at home. Again, you can see a few spots of red on this map, Norway being the most prominent due to its comparative size to Moldova. Norway, again, has been hit by oil prices, but is only down 1.3%, so a relatively mild recession. However, while it looks like the growth prospects for Europe in the long term are very good, having outperformed most other developed nations, the long-term prospects of Europe have been called into question this year. A lot of the growth that we're seeing in Europe is being buoyed and bolstered by what I consider artificial demand. We're seeing very low, even negative interest rates from many of the European central banks, and we're also seeing large government spending projects, essentially just trying to counter out otherwise lackluster sub 1% growth rates throughout many of the more mature European economies. While this has been positive in the near term and likely will pay off over the next 2 to 2.5 years, again, it does call into question the viability of the long-term growth prospects for Europe. And that's something to consider moving past the other side of the 2019 recession, is whether or not the governments of Europe and the EU in general is creating kind of an inflationary bubble run-up that will have a resulting crash on the other side of that economic downturn. Next, we have Southeast Asia, Industrial Production Index, currently up 1.4% year over year, and is in a phase C slower growth trend. However, you can see that that tick down on the 12-12 has been relatively recent and mild, and we expect to transition back in line with our expectations moving into the remainder of 2017. Expect general acceleration from this region throughout 2017, finishing the year up 3.6%, followed by slower growth through 2018. The majority of growth here is being driven by China, and as long as the Chinese economy appears to be firing on all cylinders, we do expect their neighbors to be benefiting as well, just from their close trade relationships. The one caveat I will put here is that Japan has been relatively lackluster in terms of growth, down about 1 to 2% over the last year or two. This is despite historically low interest rates and strong government investment and strong projects trying to spur both business investment and consumer spending within Japan. Japan likely won't support much growth, if any at all, over the next year. And is definitely a risk factor if you're involved in the export side of things, looking at Southeast Asia. Finally, I've included here some managerial actions to take before the 2019 recession. As I mentioned before, we are expecting 2 years of significant general growth, and you want to take advantage of that as much as you can in order to be in a strong cash position moving into 2019, in order to mitigate and survive that recessionary period. In the interest of time, I'm going to leave this here for you to look at your leisure. Not all of these action items will apply to every industry or every company, or depending on your location within the production cycle. However, in general, these are our best bet actions in order to maximize growth over the next 2 years. And now, Courtney, I will hand it back to you to field any questions that may have been asked.
Thanks, Chris. As a reminder, please submit any questions using your webinar toolbar. And we did have a question during the presentation. Chris, during the last 2 CAPSA conventions, your firm commented that we would see a global depression around the year 2030. Is this still what you're forecasting?
Absolutely. When we take a look at the much longer term of things, moving to late 2029 into the early 2030s is when we expect that global depression. We're still waiting on seeing the various risk factors playing out and seeing which of the major risk factors that we're looking at will be the drivers of this. However, we still are confident that it will be a severe, prolonged depressionary period, and one which you should absolutely keep on your radar.
Thank you. We'll give it a little bit longer as people may be typing their questions.
Excellent. And Courtney, I know I mentioned to you earlier, and I'll say it again now for the sake of our listeners. I have this slide up here. Email us at questions@iTReconomics.com. If any of you come up with any questions regarding this presentation or anything you've heard coming out of the news or ITR economics in general, even after this presentation, please email us at questions@iTReconomics.com or submit your questions to Courtney, and she'll forward them over to me and my team. And we'd be more than happy to answer those for you moving through the remainder of this week.
Okay, well, it doesn't look like we have any more questions coming through. So this concludes our presentation. As a reminder, you will receive a survey about today's presentation. Once you complete the survey, there will be a link to download the presentation slides. In a separate email, you will also receive a recording of today's presentation. Be on the lookout for the next CAPSA webinar. Thank you.